Yes, now let us start with section 50AA. My dear students, section 50AA gets attracted when there is transfer of any one of the three capital assets. What are those three capital assets? Market linked debentures or units of specified mutual fund which are acquired on or after 1st April 2023, and unlisted bonds and unlisted debentures which are transferred after 23rd July 2024. So whatever the third capital asset is there, third capital asset will get, like for third capital asset 50AA gets attracted only if transfer takes place on or after 23rd July 2024. So when any one of these three capital assets are transferred, section 50AA is applicable. Sir, what if section 50AA is applicable? If 50AA is applicable, all these three capital assets are always treated as short-term capital assets irrespective of period of holding. That means you need not check period of holding. Straight away you can conclude those three capital assets as short-term capital assets, and on transfer of those short-term capital assets, short-term capital gain or short-term capital loss will arise. Is it clear? Good. Now, let us discuss in detail market linked debenture. Sir, what do you mean by market linked debenture? Market linked debenture means generally in case of debentures interest will be paid. In case of market linked debentures also interest will be paid, but interest is not prefixed. Interest is dependent upon the returns of the market. Okay, you can see market linked debenture means a security which has an underlying principal component in the form of debt security, and where the returns are linked to market returns on other underlying securities or indices. That means fixed rate of interest will not be there on market linked debentures, and interest will be paid on market linked debentures based on the behavior of the market. I gave one example. Through this example you will understand what market linked debentures means. For example, a company issues 3 years market linked debentures. I purchased from a company 3 years market linked debentures. What amount I paid? I paid 10 lakh rupees. And when this 10 lakh rupees will be given back to me, this 10 lakh rupees will be given back to me after a period of 3 years. Linked benchmark is Nifty 50 index. That means what? Rate of interest is not predefined. I don't know what is the rate of interest, and rate of interest is dependent upon Nifty 50 index. That means if Nifty 50 index increases, I will get more interest. If Nifty 50 index decreases, I will get lower interest. That means when I purchase market linked debenture, I do not know initially what is the rate of interest that I will get, because rate of interest is dependent upon returns of the market. Okay, so here see return structure. If Nifty rises by 20% or more, that means if Nifty value increases by 20% or more than 20%, then investor will get 25% return. I invested 10 lakhs, right? After 3 years I will get 12 lakh 50,000. If Nifty 50 rises between 5% and 20%, then investor gets a proportionate return. If Nifty 50 falls or remains flat, only principal amount is returned. That means the rate of interest is not fixed, it is subject to change with regard to behavior of the returns of the market. If returns of the market increases, I will get higher interest rate. If returns of the market reduces, I will get lower interest rate, or I may not get interest also. That means what? In case of market linked debentures, the interest component is dependent upon the returns of the market. Such type of debentures we call as market linked debentures. When you sell market linked debenture or when you transfer market linked debenture, always short term capital gains will arise, because market linked debenture is always treated as short term capital asset. Is it clear? Good. Next. Unit of a specified mutual fund acquired on or after 1st April 23. That means if I purchase unit before 1st April 23, 50AA will not get attracted. 50AA gets attracted only if I purchase unit of specified mutual fund on or after 1st April 2023. Is it clear? Now, sir, what do you mean by specified mutual fund? Generally, what mutual fund will do? Mutual fund will take money from unit holders. So, mutual fund is there. It takes money from unit holders. So out of money taken from unit holders, if it takes 100 rupees amount, that mutual fund should invest in equity shares of domestic company. If that mutual fund invests less than or equal to 35% in equity shares of domestic company, let's say I am the mutual fund, unit holders gave 100 rupees to me. With this 100 rupees, from this 100 rupees, I should invest either 35% or less than 35% in equity shares of domestic company. Then this mutual fund we call as specified mutual fund. Is it clear? So specified mutual fund means a mutual fund out of total money received from unit holders which invests either 35% or less than 35% in equity shares of domestic company. Then that mutual fund we call as specified mutual fund. Okay, if this specified mutual fund units are purchased on or after 1st April 2023, then section 50AA gets attracted. Is it clear? Are you able to understand? Good. If section 50AA gets attracted, always they are treated as short-term capital assets. Full value of consideration we will take. Transfer expenses are allowed as deduction, but securities transaction tax is not allowed as deduction. Indexed cost of acquisition is not allowed as deduction. Only normal cost of acquisition will be allowed as deduction. And whatever the resultant capital gains are there, they will be considered as short-term capital gain or short-term capital loss. In this scenario, I wanted to explain another point. Mutual fund is there. Out of total money, out of total amount received from unit holders, if greater than 65% is invested in equity shares of domestic company, then that mutual fund we call as equity oriented mutual fund. Out of total money received from unit holders, if less than or equal to 35%, less than or equal to 35% are invested in equity shares of domestic company, then that mutual fund we call as specified mutual fund. So now did you understand the difference between specified mutual fund and equity oriented mutual fund? More than 65% invested in equity shares of domestic company, it's a equity oriented mutual fund. If mutual fund invests either 35% or less than 35% in equity shares of domestic company, then that mutual fund we call as specified mutual fund. We will do one problem so that you will get clarity. XYZ, ABC, AB and C are resident individuals. They transfer following mutual fund units or debentures. First, let us solve one by one. Let us solve in case of Mr. X. Name of the mutual fund is SBI Mutual Fund. When it was purchased on January 1, 2023. January 1, 2023 means before 1st April 23, right? So if date of purchase is before 1st April 2023, whether 50AA gets attracted, I clearly told when you purchase units of specified mutual fund on or after 1st April 2023, then only 50AA is applicable. How much percentage is invested in equity shares? 30%. That means less than 35%, right? It is a specified mutual fund. Even though it is specified mutual fund, 50AA is not applicable. Why 50AA is not applicable? Because date of purchase is before 1st April 2023. So in this case, 50AA is not applicable. Whether 112A is applicable, when 112A is applicable, if the mutual fund is equity oriented mutual fund, then 112A is applicable. Here mutual fund is not equity oriented mutual fund because percentage of investment is only 30%. If percentage of investment is greater than 65%, then we call it as equity oriented mutual fund. Here it is a specified mutual fund and not equity oriented mutual fund. If it is not equity oriented mutual fund, 112A is also not applicable. Then which section is applicable? Section 112 is applicable. When these are transferred on May 15, 2026. That means previous year 26-27. I told you on or after 23rd July 2024, indexation benefit is not available. So even though it is a long-term capital asset because they are purchased on January 23 and transferred on May 15, 2026. So it is a long-term capital asset. Even though it is long-term capital asset, indexation benefit is not available because date of transfer is on or after 23rd July 2024. So full value of consideration is sale consideration. How much is sale consideration? 26 lakhs. What is cost of acquisition? They are purchased for 11 lakhs. 11 lakhs is cost of acquisition. So how much is long-term capital gain? 15 lakhs is long-term capital gain. Did you understand? Next, in case of Mr. Y, when they are purchased January 1, 2023, that means these are also purchased before 1st April 23, right? Whenever they are purchased before 1st April 2023, first of all, how much percentage is invested? 50% is invested in equity shares of domestic company. Then can you call it as specified mutual fund? No, you will call it as specified mutual fund only if percentage of investment is either 35% or less than 35%. Now, can you call it as equity oriented mutual fund? You cannot call it. To call it as equity oriented mutual fund, greater than 65% should be invested in equity shares. Here percentage of investment is only 50%. So it is not a specified mutual fund, it is not a equity oriented mutual fund. So 50AA is not applicable, 112A is also not applicable. In that case, section 112 is applicable. When they are transferred May 15, 2026, they are transferred after 23rd July 2024. So obviously indexation benefit is not available even though they are long-term capital assets. Sale consideration 28 lakhs. Cost of acquisition is 14 lakhs. So 28 lakhs minus 14 lakhs. 14 lakhs will be the long-term capital gain. Is it clear? Next. In case of Mr. Z, name of mutual fund is SBI Mutual Fund. When they are purchased 10th April 2023. How much is percentage of investment? Percentage of investment is 30%. That means less than 35%. So can you call it as specified mutual fund? Yes, we can call it as specified mutual fund. When it was acquired after 1st April 23, right? So specified mutual fund units acquired after 1st April 23. So 50AA is applicable. If 50AA is applicable, then it is considered as short-term capital asset. If 50AA is applicable, 112 and 112A is not applicable. The reason is once 50AA is applicable, the capital asset is always treated as short-term capital asset. So in case of short-term capital asset, sale consideration 24 lakhs. Cost of acquisition 7 lakhs. Cost of acquisition 17 lakhs. 24 minus 17, how much? 7 lakhs is short-term capital gain. So 24 lakhs minus 17 lakhs, 7 lakhs will be considered as short-term capital gain. Next, in case of Mr. A, they are purchased after 1st April 23. But how much is percentage of investment? Percentage of investment is 50%. Now, can you call it as specified mutual fund? No. Can you call it as equity oriented mutual fund? No. If it is not specified mutual fund, 50AA is not applicable. If it is not equity oriented mutual fund, 112A is not applicable. In that case, section 112 is applicable. But they are transferred on May 15, 2026, which is previous year 26-27. In previous year 26-27, indexation benefit is not available because these are transferred after 23rd July 2024. So sale consideration 43 lakhs minus cost of acquisition. Cost of acquisition is 12 lakhs. Balance 31 lakhs will be considered as long-term capital gain. Is it clear? Next. In case of Mr. B, SBI Mutual Fund, date of acquisition June 30, 2021. Okay. Amount invested 21 lakhs. Percentage of investment is 70%. That means greater than 65%. So can we call it as equity oriented mutual fund? Yes, because percentage of investment is more than 65%. So in case of equity oriented mutual fund unit, which section gets attracted? 112A will get attracted. 50AA and section 112 are not applicable. How much is sale consideration? 69 lakhs. From that, cost of acquisition is allowed as deduction. How much is cost of acquisition? 21 lakhs. We already discussed in previous lecture, in case of 112A or 111A, indexation benefit is not available. As indexation benefit is not available, only cost of acquisition is allowed as deduction. 21 lakhs is allowed as deduction and balance 48 lakhs are considered as long-term capital gain. Next, debentures of P Limited. These are market linked debentures. For market linked debentures, section 50AA gets attracted. If 50AA gets attracted, it is always treated as short term capital asset, and a difference between full value of consideration and cost of acquisition is considered as short term capital gain. How much is full value of consideration? 28 lakhs. How much is cost of acquisition? Cost of acquisition is 23 lakhs. How much is short term capital gain? Short term capital gain is 5 lakhs. Is it clear? I hope you understood the concept of section 50AA and section 112A or 111A. Now let us discuss tax rates. There are amendments with regard to tax rates, so please listen very carefully. Before I start discussing about the tax rates, in the introduction chapter booster series, whatever the material that we have released, in that material there is small mistake with regard to long-term capital gain under section 112A, and we have updated our material. You can go and check now. Okay, that mistake invariably happened when I prepared the amendments before release of ICA material. After releasing ICA material, that mistake was rectified, and whatever this provision that you are seeing right now here, that is correct only. So this is just a disclaimer. If you have downloaded previous version of our introduction material, go now and download the updated version. In updated version, you will find this provision in incomes taxable at special tax rates. Okay. Long-term capital gain under section 112A. You know, when long-term capital gain under section 112A gets attracted, when you transfer either listed equity shares or units of equity oriented mutual fund or units of business trust, then section 112A gets attracted. If section 112A gets attracted, what is the tax rate, sir? If long-term capital gain under section 112A is up to 1.25 lakh, then it is fully exempt. If long-term capital gain under section 112A is greater than 1.25 lakh, in such a case, up to 1.25 lakh, it is exempt. Greater than 1.25 lakh, tax rate is 10% if transfer takes place before 23rd July 2024. Tax rate is 12.5% if date of transfer is on or after 23rd July 2024. So if date of transfer is before 23rd July 2024, what is the tax rate applicable? 10%. If date of transfer is on or after 23rd July 2024, long-term capital gain under section 112A is taxable at the rate of 12.5%, not 12%, 12.5%. Okay. This is the amendment. For example, long-term capital gain under section 112A is 6 lakhs. Out of 6 lakhs, 1.25 lakhs is exempt. Balance how much? 6 lakhs minus 1.25 lakhs. It is 4.75 lakhs. So balance 4.75 lakhs. If date of transfer is before 23rd July 2024, on 4.75 lakhs, you will apply 10% tax rate. If date of transfer is on or after 23rd July 2024, then on 4.75 lakhs, you will apply 12.5% tax rate. Is it clear? So, in excess of 1,25,000, that means long-term capital gain under section 112A up to rupees 1,25,000, it is not taxable. Up to rupees 1,25,000, it is fully exempt. Greater than 1,25,000, applicable tax rate is 10% if transfer is before 23rd July 2024. If transfer is made on or after 23rd July 2024, tax rate applicable is 12.5%. Is it clear? And for 24-25 together, for previous year 24-25 together, maximum exemption allowed for long term capital gain under section 112A is total exemption, maximum exemption allowed is 1.25 lakhs. Exemption cannot exceed 1,25,000. Up to 1,25,000 only long term capital gain under section 112A is exempt. Balance long term capital gain under section 112A over and above 1,25,000, whatever the extra long term capital gain is there, that is taxable. How it is taxable? You have to check date of transfer. If date of transfer is before 23rd July, you have to apply 10%. If date of transfer is on or after 23rd July, you have to apply 12.5% tax rate. Is it clear? Good. Next, long term capital gain under section 112. See, listed equity shares, units of equity oriented mutual fund, units of business trust. For these three capital assets, 112A gets attracted. Other than these three capital assets, remaining all capital assets, 112 gets attracted. I sold building, I sold gold, okay, I sold land, I sold paintings, I sold archaeological collections, then section 112 gets attracted. Okay, so what are the tax rates for long term capital gain under section 112? If date of transfer is before 23rd July 2024, then if the capital asset transferred is listed securities other than units or a zero coupon bond, that means what? Long term capital gain under section 112 before 23rd July 2024. Capital asset transferred. If capital asset transferred is listed securities other than units zero coupon bonds. That means if capital asset transferred is listed securities or zero coupon bonds, then two alternatives are there. Alternative 1, calculate capital gains with indexation and tax rate of 20%. Alternative 2, calculate capital gains without indexation, very important, without indexation and tax rate of 10%. That means on transfer of listed securities other than units and zero coupon bonds, we will calculate capital gains twice. First, we will calculate capital gains by taking indexation benefit and applying tax rate of 20%. Next, we will calculate capital gains without taking indexation benefit and applying tax rate of 10%. Out of these two options, wherever the assessee gets lower tax, that option we will choose. Okay, so for listed securities other than units and zero coupon bonds, you have option. Either you can claim indexation benefit and pay tax at the rate of 20%, or you do not take indexation benefit and can pay tax at the rate of 10%. What we do, we will do two calculations. We will take indexation benefit, we will calculate tax at the rate of 20%. We do not take indexation benefit, we will calculate tax at the rate of 10%. Out of these two options, A option or B option, wherever the assessee gets lower tax, we will choose that option. Is it clear? But this optional benefit is available only for listed securities other than units or zero coupon bonds. For other assets, the tax rate applicable is 20% with indexation benefit. Before 23rd July 2024, I sold gold. What is the tax rate? Tax rate is 20% and I can claim indexation benefit. Are you able to understand? So before 23rd July 2024, long term capital gain under section 112, tax rate is 20% with indexation benefit. But major amendment, on or after 23rd July 2024, indexation benefit was removed. Generally, for long term capital asset, you can claim indexed cost of acquisition. But if date of transfer is after 23rd July 2024, in recent budget, Finance Act number 2 of 2024, Nirmalamma, she waived off indexation for long-term capital assets. Generally, for long-term capital assets, indexation benefit is available. But if date of transfer is on or after 23rd July 2024, indexation benefit is no longer available. So from 23rd July 2024 onwards, even for long-term capital asset also, indexed cost of acquisition is not allowed as deduction, only cost of acquisition is allowed as deduction. So from 23rd July 2024 onwards, without indexation benefit, that means indexation benefit is not available. As indexation benefit is not given, tax rate was reduced. Before 23rd July 2024, what is the tax rate? Tax rate is 20%. On or after 23rd July 2024, tax rate is 12.5%. That means before 23rd July 24, on or after 23rd July 2024. Let us just compare. Before, tax rate is 20%. Now tax rate is 12.5%. That means tax rate got decreased. Before, indexation benefit is allowed. Now indexation benefit is not allowed. As indexation benefit is not allowed, tax rate was decreased from 20% to 12.5%. Is it clear? But there is one exception. Listen carefully. Long-term capital gain under section 112, before 23rd July 2024, tax rate is 20%, indexation benefit is allowed. But from 23rd July 24 onwards, if you transfer a long-term capital asset, indexation benefit is no longer made available and tax rate is reduced to 12.5%. But there is one exception. What do you mean by this? 23rd July 2024. Before, whether indexation is allowed? Yes, indexation benefit is allowed. On or after, whether indexation benefit is allowed? Indexation benefit is not allowed except in one situation. That means what? Even on or after 23rd July 2024 also, only in one situation indexation benefit is allowed. Are you able to understand? Generally, on or after 23rd July 2024, indexation benefit is not available except one situation. That means only in one situation, even on or after 23rd July 2024, indexation benefit is available. What is that one situation? Let us see. Here there are 4 conditions. 1, 2, 3, 4. Conjunction is and. If all these 4 conditions are satisfied, then even though capital asset is transferred on or after 23rd July 2024, still indexation benefit is available. Are you able to understand? First, who is the transferor? Transferor should be resident individual or resident HUF. And what is the capital asset transferred? Capital asset transferred is land or building or both, either residential land or residential building or commercial land or commercial building. When it should be purchased, it should be acquired before 23rd July 2024. And when it should be transferred, it should be transferred on or after 23rd July 2024. I am telling you once again, after 23rd July, indexation benefit is not available except in one situation. That exception we are going to discuss right now. This exception is available to whom? Okay. Available only to resident individual or resident HUF. Resident individual or resident HUF. And what is the capital asset that is required to be transferred? Capital asset to be transferred is house property. That house property can be either residential or commercial. Capital asset required to be transferred is house property or immovable property. Write down like this. Capital asset required to be transferred is immovable property. When it should be purchased? It should be purchased before 23rd July 24. When it should be transferred? It should be transferred on or after 23rd July 2024. That means what? You should purchase the immovable property before 23rd July 24 and that immovable property should be transferred on or after 23rd July 24. So in total how many conditions? 1, 2, 3, 4. If all these 4 conditions are satisfied means you will calculate capital gains, right? If all these 4 conditions are satisfied means SSC is having 2 options while calculating tax. So in tax calculation, SSC will be having 2 options. Option 1, calculate tax at the rate of 12.5% without indexation benefit. Option 2, calculate tax at the rate of 20% with indexation benefit. Out of these two, wherever tax is lower, that tax we are going to pay to the government. Is it clear? So option 1, pay tax at the rate of 12.5% without indexation. Option 2, pay tax at the rate of 20% with indexation. See, this benefit is available only at the time of calculation of tax. Benefit is not available at the time of calculation of capital gain. You will not understand my statement. Let us do one problem, then you will get clarity. Once again, let me revise very quickly. On or after 23rd July 2024, indexation benefit is not available for long-term capital asset except in one situation. What is that one situation? For that situation, 4 conditions are there. Capital asset should be transferred by resident individual or HUF, resident HUF, and capital asset transferred should be immovable property. It should be purchased before 23rd July 24 and it should be transferred on or after 23rd July 2024. If all these 4 conditions are satisfied, what is the conjunction? Conjunction is and all the 4 conditions are required to be satisfied. If all these 4 conditions are satisfied, then in tax calculation, benefit is available not in calculation of income. Benefit is available at the time of calculation of tax liability. So when you are calculating tax liability, calculate like don't take indexation benefit, calculate tax at the rate of 12.5%. Option 1. Take indexation benefit, calculate tax at the rate of 20%. That is option 2. So out of these 2 options, wherever SSC gets lower tax, that lower tax we are going to pay to the government. Okay, shall we see the example? XYZ and wants to ascertain their tax liability pertaining to transfer of land, building given below. See, whenever land or building is transferred, then they can get covered under exception, right? Let us see. In case of Mr. X, sale consideration 40 lakhs, stamp duty value 39 lakhs. Okay, whenever land or building is transferred, they are immovable property, right? So section 50C gets attracted. As per 50C, what is the provision? We need to compare stamp duty value with 110% of actual consideration, correct? How much is stamp duty value in case of X? Stamp duty value is 39 lakhs. How much is 110% of actual consideration? 110% of actual consideration is 44 lakhs. Stamp duty value is less than 110% of actual consideration. So full value of consideration is equal to actual consideration, which is equal to 40 lakhs. Good. Cost of acquisition 20,000. Cost of improvement 3,000. Transfer expenses are 0. Date of acquisition. When this was purchased? May 10, 2004. When this was transferred? July 30, 2024. Now, let us see whether 4 conditions are satisfied or not. What is condition 1? Condition 1 must be assessee should be a resident individual. Here let us take the assumption X is a resident individual. Income other than capital gain is not more than 15 lakhs. Good. Let us take the assumption assessee is a resident individual. Condition 1 satisfied. Condition 2, capital asset transferred is land. So condition 2 is also satisfied. When it was purchased before 23rd July 2024. So condition 3 also satisfied. Condition 4, it should be transferred on or after 23rd July 2024. When it was transferred 30th July, that means after 23rd July 2024, right? So all the four conditions are satisfied. Condition 1, resident individual. Capital asset transferred is immovable property. It was purchased before 23rd July. It was transferred after 23rd July. So he has two options. While calculating tax, he has two options. What is option 1? Option 1, option 2. As per option 1, indexation benefit is allowed. Tax rate applicable is 20%. Option 2, indexation benefit is not allowed. Tax rate is 12.5%. Shall we calculate? First, I will calculate under option 1. I will take indexation benefit and I will calculate tax at the rate of 20%. How much is full value of consideration? Full value of consideration is, we have calculated, right? Full value of consideration is 40 lakhs. From this, indexed cost of acquisition is allowed. What is formula for indexed cost of acquisition? Cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. So how much is cost of acquisition? Cost of acquisition is 20,000. When it was purchased in 2004. So for 2004, what is the index number? Go and check. 2004 index number. For 2004-5 index number is 113. For 2024-25 index number is 363. So 113, 363. So 20,000 into 363 divided by 113. How much? 64,247. How much is cost of improvement? Cost of improvement is 3,000. So 3,000 into 363 by 113. How much? 9637. So how much is long-term capital gain now? 40 lakhs minus 64,247 minus 9,637. 39 lakh 26,116. What is the tax rate applicable? Tax rate applicable is 20%. So how much is tax? 7,85,223. Is it the tax? So here he took HEC also. So including HEC, let us calculate. To this, let us add HEC. How much is HEC? 31,409. So total 8,16,632. So option 1, as per option 1, tax is 8,16,632. As per option 2, we should not claim indexation benefit. So full value of consideration is 40 lakhs. We do not claim indexation. So we will claim cost of acquisition. How much is cost of acquisition? 20,000. We will claim cost of improvement. Cost of improvement is 3,000. So how much is capital gain? Long-term capital gain is 40 lakhs minus 23,000, 39 lakh 77,000. What is the tax rate applicable? Tax rate applicable is 12.5%. 39 lakh 77,000 into 12.5%. How much? 4,97,125. This is tax. To this we need to add HEC. HEC at the rate of 4%. How much it will be? 19,885. So how much is tax liability? 5,17,010 rupees. So where tax liability is lower? Tax liability is lower under option 2. So I will not claim indexation benefit. Instead, I will pay tax at the rate of 12.5% plus HEC at the rate of 4% because here the tax is lower. Is it clear? So if SSE is resident individual or HUF and capital asset transferred is immovable property, and if that immovable property is purchased before 23rd July 2024 and is transferred on or after 23rd July 2024, then SSE will be having two options: claim indexation benefit, pay tax at the rate of 20%, or don't claim indexation benefit and pay tax at the rate of 12.5%. Wherever the SSE gets lower tax, we will ask the SSE to pay tax under that option. Is it clear? So did you understand in case of Mr. X? Shall we do in case of Mr. Y? Shall we do? Yes. In case of Mr. Y, what is sale consideration? 41 lakhs. Stamp duty value 41 lakh 50,000. Here the property that is transferred is immovable property. So section 50C gets attracted. We will compare stamp duty value with 110% of actual consideration. How much is stamp duty value? Stamp duty value is 41 lakh 50,000. How much is actual consideration? Actual consideration is only 41 lakhs. How much is 110% of actual consideration? 45 lakh 10,000. So stamp duty value is lower than 110% of actual consideration. So in this case, full value of consideration is equal to actual consideration, which is equal to 41 lakhs. Now, see, this property is transferred by Y. Let us assume Y is resident individual and property that is transferred is land. Condition 2 also satisfied. When it was transferred June 10, 2005, that means when it was purchased, date of acquisition. Date of acquisition is before 23rd July 2024. When it was transferred July 25. July 25 means what? After 23rd July only 25 July comes, right? So 25th July means after 23rd July 2024. All the four conditions are satisfied. So now in case of Mr. Y, in tax calculation, two options are there. In tax calculation, two options are there. First, option 1, claim indexation benefit. Pay tax at the rate of 20%. Option 2, don't claim indexation benefit. Pay tax at the rate of 12.5%. So these are the two options that are available. Now let us see. Let us calculate option 1. Under option 1, full value of consideration is equal to 41 lakhs. Indexed cost of acquisition is allowed as deduction, right? Indexed cost of acquisition formula is cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. So how much is cost of acquisition? Cost of acquisition is 15 lakhs. Cost of improvement is 4,000. When it was purchased June 10, 2005, that means date of purchase is previous year 5/6, correct? So for previous year 5-6, what is the index number? Let us check. 5-6 index number is 117. For 24-25 index number is 363. So how much cost of acquisition is? How much? Cost of acquisition is 15 lakhs. 15 lakhs into 363 divided by 117. How much? 46 lakh 53,846. There is cost of improvement also, right? How much is cost of improvement? 4,000. So 4,000 into 363 divided by 117. 12,410. So is there gain or loss? There is loss. How much is long-term capital loss? 41 lakh minus 46 lakh 53,846 minus 12,410. 5 lakh 66,256. If it is loss, will there be any tax? Tax will be 0. So in case of loss, tax is 0. Now, option 2, don't claim indexation benefit, calculate tax at the rate of 12.5%. As per option 2, how much is full value of consideration? Full value of consideration is equal to 41 lakhs. Whether indexed cost of acquisition is allowed as deduction? No. Only cost of acquisition is allowed. How much is cost of acquisition? 15 lakhs. Whether indexed cost of improvement is allowed as deduction? No. Only cost of improvement is allowed as deduction. How much? 4,000. Now, how much is long-term capital gain? Long-term capital gain is 41 lakh minus 15 lakh minus 4,000. 25 lakh 96,000. Tax at the rate of 12.5% plus 4% HEC. So effective tax will be 13%. 25 lakh 96,000 into 13%. How much? Tax amount is 3 lakh 37,480. Tell me, is it better to pay zero tax or is it better to pay tax of 3 lakh 37,480? Out of these two, which is lower? The lower one is tax of 0. So we will ask the SSC to take indexation benefit and calculate tax at the rate of 20%. In that case, tax amount is 0. He is not required to pay tax. Now you will get one doubt. What is that doubt? Sir, here there is long-term capital loss of 5,66,256, right? Can I carry forward it to next year? No, you cannot carry forward it to next year. The reason is, I said the benefit is available only for tax calculation. The benefit is not available for calculation of income. For calculation of income, benefit is not available. Benefit is available only for calculation of tax liability. Is it clear? So what I told, if 4 conditions are satisfied, in tax calculation, benefit is available. Benefit is not available for calculation of income. That means what? Ideally, long-term capital gain is 25 lakh 96,000 only. Long-term capital gain is 25 lakh 96,000, but tax amount is 0. Okay. So if all the 4 conditions are satisfied, resident individual or HUF can pay tax as per 2 options. That means options are available for tax liability calculation. Option is not available for calculation of income. So ideally, on or after 23rd July 2024, indexation benefit is not available. So long-term capital gain is 25 lakh 96,000, but tax amount is 0. Is it clear? So whatever the long-term capital loss that will come if indexation is claimed, that long-term capital loss cannot be carried forwarded to subsequent years, because if the 4 benefits are, if the 4 conditions are satisfied, benefit is available only for calculation of tax. benefit is not available for calculation of income. So I hope you understood the concept now. So on or after 23rd July 2024, if you are transferring long-term capital asset being immovable property, and if that long-term capital asset is transferred by resident individual or HUF, if that long-term capital asset is purchased before 23rd July 24 and transferred on or after 23rd July 2024, if these four conditions are satisfied, SSC will get a benefit in tax calculation. SSC will not get benefit in income calculation. That means in calculation of gross total income, you will not claim indexation benefit. But when you are calculating tax liability, you will check two options. In option 1, you will claim indexation. You will calculate tax at the rate of 20%. In option 2, you will not claim indexation and you will calculate tax at the rate of 12.5%. So the benefit is available only in tax calculation. The benefit is not available in calculation of income. If benefit is available in calculation of income, then this loss of 5,66,256 will be carried forwarded to subsequent years. But that loss cannot be carried forward because the benefit is not given for calculation of income. The benefit is given for tax calculation. Is it clear? Good. Now, in case of Mr. Z, sale consideration is 42 lakhs, stamp duty value 37 lakhs, cost of acquisition 80,000, cost of improvement 6,000, date of acquisition July 10, 2005. That means before 23rd July 24, right? What is date of transfer? July 2024. July 2024 means it is also before 23rd July 2024, right? So fourth condition not satisfied. What is fourth condition? That immovable property should be transferred on or after 23rd July 24. But here it was transferred on July 20. July 20 means what? Before 23rd July 24. So condition 4 is not satisfied. If condition 4 is not satisfied, benefit is not available. Regular calculation only we will do. So before 23rd July 2024, what is the provision? Before 23rd July 2024, tax rate is 20% and you can claim indexation benefit. That's how. So how much is stamp duty value? Stamp duty value we should compare with 110% of actual consideration. How much is actual consideration? Actual consideration is how much? 42 lakhs. Actual consideration 42 lakhs. Stamp duty value 37 lakhs. So 42 lakhs into 110%, how much? 46 lakh 20,000. Stamp duty value is less than 110% of actual consideration. So full value of consideration is equal to actual consideration, which is equal to 42 lakhs. See, this transaction transfer was done before 23rd July 2024, right? So what is allowed as deduction? Indexed cost of acquisition is allowed as deduction. What is the formula? Cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. Now, when it was purchased in 2005-6. For 2005-6, what is the index number? See, this is not regular class. In regular class, there will be students. Student will tell the index number. Now I have to search. I need not search because in previous problem also it was transferred in 2005-6, right? So for 2005-6, index number is 117. How much is cost of acquisition? 80,000. 80,000 into 363 divided by 117. How much? 2,48,205. Next, indexed cost of improvement. How much is cost of improvement? Cost of improvement is 6,000. 6,000 into 363 by 117. How much? 18,615. So now how much is long-term capital gain? 39,33,180. So on this you will apply 20% plus HEC 4%. Is it clear? Earlier calculation only. So I hope you understood this concept. Now let us discuss buyback of shares. With regard to buyback of shares also, there is an amendment. Let us see now. You have to remember the date 30th September 2024. Up to 30th September 2024, there is one methodology for calculation of buyback. On or after 1st October 2024, there is another methodology. First, let us discuss what is the tax treatment in case of buyback up to 30th September 2024. See, before 1st October 24, that means up to 30th September 2024, if buyback is done by domestic company, then tax rate applicable is then domestic company is required to pay tax on additional income at the rate of 23.296% on distributed income. What is distributed income? Distributed income is equal to buyback price minus issue price. On distributed income, company is required to pay 23.296% tax when before 1st October 24. And as company is already paying tax, domestic company, in the hands of shareholders, that is fully exempt under section 1034A. But if buyback is done by other than domestic company, that means if buyback is done by a foreign company is not required to pay any tax, but shareholders, in the hands of shareholders, they are required to calculate capital gains, because buyback is extinguishment of capital asset. Shareholder is giving the share and he is receiving the amount. So as it amounts to extinguishment of capital asset, shareholder is required to calculate capital gains. This is the scenario before 1st October 24. If domestic company has done buyback, domestic company is required to pay tax at the rate of 23.296% on distributed income. In the hands of shareholders, it is not taxable, it is exempt because the company is paying tax at the rate of 23.296%. If buyback is done by foreign company, in the hands of foreign company, tax treatment there is no tax. In the hands of shareholders, income tax is required to be shareholders are required to calculate capital gains under section 46A. Is it clear? With effect from with regard to this, let us do one problem. Then I will explain what is the tax treatment with effect from 1st October 24. Okay, shall we do the problem? See this. On March 3, 2023, X Limited purchases its own shares, face value 10 rupees, amount offered to shareholders. Amount offered to shareholders means nothing but buyback price, correct? Total amount distributed by X Limited on buyback of 20,000 shares is 18 lakhs. These shares were issued in 2004-5. When they are issued in 2004-5. They are issued at a premium. You know, right? Issue price is equal to face value plus securities premium. How much is issue price? They are offered at face value is 10 rupees. Issue price, securities premium is 15 rupees. So issue price is 25 rupees. Are you able to understand? A is one of the shareholders. He holds 2000 shares. Cost of acquisition is 27 per share. Year of acquisition 2007-8. He gets 1,80,000. Compute tax liability in the hands of A and X Limited. Now let us take the assumption X Limited is a domestic company. Whenever buyback is done by domestic company before 1st October 24, in the hands of domestic company is required to pay tax at the rate of 23.296% on distributed income. In the hands of shareholder, nothing is taxable, fully exempt. The reason is company is already paying the tax. So A is not chargeable to tax. Why A is not chargeable to tax? Because in the hands of shareholder it is not taxable, fully exempt, because company is required to pay tax. How much company is required to pay tax on distributed income? Distributed income is equal to buyback price minus issue price. How much is buyback price? Buyback price is 90 rupees. Issue price is 25. So how much is distributed income? 90 minus 25, 65 rupees is distributed income. Now tax. 65 rupees into how many shares are bought back? 20,000 shares. 65 into 20,000. How much? It is 13 lakhs. So 13 lakhs into 23.296%. How much? 3,02,848. Is it the answer? Yes, the answer is 3,02,848. So before 1st October 24, if domestic company has done buyback, tax is required to be paid by domestic company on distributed income at the rate of 23.296%. On or off, in the hands of shareholder, nothing is taxable, it is fully exempt. Now, with effect from 1st October 2024, domestic company, foreign company concept is not there. There is only single tax treatment. From 1st October 24 onwards, in the hands of company, company is not liable to pay any tax. So old provision 23.296% tax on distributed income is required to be payable by domestic company. That concept is not applicable with effect from 1st October 2024. Are you able to understand? So with effect from 1st October 2024, in the hands of company, nothing is taxable. In the hands of shareholder only, tax liability gets erased. Is it clear? But one thing is, in the hands of company, company is not required to pay tax. But before paying buyback amount, company is required to deduct TDS under section 194 at the rate of 10%. Is it clear? So from 1st October 24 onwards, whenever buyback is done by company, in the hands of company, tax is not required to be paid, but company is liable to deduct TDS before paying buyback amount at the rate of 10% under section 194. Is it clear? Now, in the hands of shareholder, whatever the buyback amount received is there, buyback amount received is taxable under other sources. Buyback amount received is taxable under other sources. And shareholder is also required to calculate capital gains. See, whatever the amount that is received on buyback, it is already getting taxed under other sources. As it is already getting taxed under other sources, when you are calculating capital gains, full value of consideration is to be taken as 0. Why full value of consideration is taken as 0? If you take full value of consideration as buyback amount, it amounts to double taxation. Under other sources, it is getting taxed. Under capital gains also, it will get taxed. It amounts to double taxation. So to prevent double taxation, what it was said, on buyback, whatever the amount that is received is there, that is taxable under income from other sources. And when you are calculating capital gains, full value of consideration is to be taken as 0 because already that amount got taxed under other sources, and you will claim cost of acquisition. Indexation benefit is not available. Why indexation benefit is not available? 1st October 2024. 1st October 24 means after 23rd July, right? After 23rd July 24, whether indexation benefit is available on shares, indexation benefit is not available. That's why you will claim only cost of acquisition as deduction. After claiming cost of acquisition as deduction, you will get either long-term capital loss or short-term capital loss. Why I used the word capital loss? If you take consideration as 0, whatever the cost of acquisition is there, that amount will be considered as capital loss. That's why only loss will come, long-term capital loss or short-term capital loss. Shall we see one problem so you will get better understanding? 150 shares are bought in 2005 at the rate of 50 per share. When they are bought 2005, 20 shares are bought back on 9th December 2024 at the rate of 65 per share. Now, when the transaction is happening 9th December 2024, that means after 1st October 24, right? After 1st October 24, whether old rules are applicable or new rules are applicable. New rules are applicable for buyback. So as per new rules, whatever the buyback amount that is received is there, that is taxable under other sources. How much is received? 65 rupees is received for 20 shares. 65 rupees is received for 20 shares. 65 into 20, how much? 1300 rupees is taxable under other sources. Is it clear? So very simple. Whatever the amount received on buyback, that is taxable under other sources. And we also need to calculate capital gains. So on 20 shares bought back, we need to calculate capital gains. What I said, full value of consideration is taken as 0. Why? To prevent double taxation. If you take 1300 as capital gains, 1300 will get taxed under capital gains. It will also get taxed under other sources. It amounts to double taxation. So to prevent double taxation, like full value of consideration we have to take as 0. Cost of acquisition, at what price they are bought? They are bought for 50 rupees. So 50 rupees into 20 shares, how much? 1000 rupees is cost of acquisition. So how much is long term capital loss? 1000. Why long term? They are purchased in 2005. Buyback happened in 24-25. Obviously period of holding is greater than 24 months. See, on or after 23rd July 2024, there are only two categories. Category 1 12 months, category 2 24 months. Correct? So this is unlisted share. It will fall under category 2, period of holding greater than 24 months, classified as long-term capital asset. Is it clear? So whatever this long-term capital loss is there, this can be set off as per the set off rules. As per set off rules, long-term capital loss can be set off only against long-term capital gain. If after setting off, if there is balance, that will be carry forwarded to subsequent years. Even in subsequent years also, long-term capital loss can be set off only against long-term capital gains. That's the rule, right? Now, there is second transaction. 50 shares are sold on 16th January 2025. So on sale of 50 shares, we need to calculate capital gains, right? So 75 into 50, how much? 3750, correct? So full value of consideration is equal to 3750. 50 shares are purchased for 50 rupees. They are purchased for 50 rupees. So 50 shares into 50 rupees, how much? 2500. How much is long-term capital gain? Long-term capital gain is 1250 rupees. See, on buyback, there is long-term capital loss of 1000 rupees. And in the same year, there is long-term capital gain of 1250. Can you set off long-term capital loss with long-term capital gain? Yes, you can set off. After set off, how much is long-term capital gain that is taxable? Long-term capital gain that is taxable is 250 rupees. Now, did you understand? So, these are the amendments. So, all amendments were clearly discussed in this capital gains part. If you find this content very much useful, I am saying this at the end because I don't want to make money out of this. Only if you feel useful, only if you feel it is worthy, share this content with your friends. Okay? Because I have spent more than 4 lakhs to get these videos on YouTube for you. So whatever the expenditure that I have spent, this expenditure should create benefit to maximum number of students. That's the only intention. Okay. So thank you very much. Bye.